John Cleary, Strategic Resources Chairman CEO. Strategic Resources is a Ross Beatty Lumina Group company that's just completed a transformational acquisition of BlackRock Metals in Quebec, based in Canada. Generational asset, 39-year mine life, and we're currently going through project finance to complete this. And a fully permitted project checks the box on all ESG counts. Partners with the government and the First Nations.
Right, so very, very attractive names associated with this in the sense of the Quebec government, Cisco, etc., and Ross Beatty. It's set for success, it seems, but it's a very big plan in a very small company. So, how did you pick this up? First of all, tell me a little bit about that.
So the project was originally staked and claimed in 2008. I've been working on it for the last 14 years to bring it to this point. We drilled off the property. We have about 20 kilometers of strike. We've drilled off 2 pits. In the 43-101 that we just published in November with updated numbers, we included 1 pit with a 39-year mine life. It was a generational asset. It's at surface and basically ready for construction.
Right. Okay. But like I say, so what market cap today is what?
So we're trading at about 140 million Canadian dollar market cap today.
Right. And cash position?
12 million.
12 million. Okay. And your ambition is to do what with this project in what time frame?
So over the course of the next 3 years, we would like to construct the mine and concentrator, as well as a metallurgical complex in Quebec, in Canada. The mining concentrator to produce about 1 million tons of what we call VTM concentrate per year. It's an iron-rich concentrate. So it's 62% iron, 1.4% vanadium, and 9% titanium. We'll take that and produce metallic iron product out of that, as well as it's a very high-grade metallic iron product, as well as vanadium-rich slag and a titanium-rich slag for the market. 3 products.
Right. Okay. And well, yeah. Okay. I'd love to understand the vanadium and titanium markets in a second. Get your sense on that. But given 66% of the revenue is the high purity pig iron, what did you actually set out to do? What were you looking for? Was it really just about the iron component, and the vanadium and titanium are kind of nice byproducts, or? I'm trying to, what drew you to this asset?
Well, I guess back in the day, we were looking at bulk iron projects in the province of Quebec and the Labrador Trough. This was a very attractive greenfield project that's very close to rail. So we're right by the CN Railway, and we're less than an hour's drive from the mining town of Chibougamau. So access, rail, power, cheap power in Quebec, the backing of the Quebec government, a First Nations group that is strongly commercial and willing to partner with mining companies like Strategic Resources.
Right, and with regards to the team, so I always think people should kind of stick to the knitting. So in terms of the team that you have or you are assembling, what do they know about this space in terms of the commodities that you will be pulling out of the ground?
We have a very experienced team that has been on this project for many years, geologists, metallurgical engineers, et cetera, as well as consultants to the project, very large group. Now what we've done with Strategic Resources is we've tied in the experience in bringing mines to production and doing corporate development with the Lumina Group, Ross Beatty's team out of Vancouver. So we've merged in part of their management team with the project team to basically get this company to a production scenario, and then build a great company from there.
What do you mean by production scenario? You guys want to build it, or you guys want to flip it?
Well, we're going to build it, but we're always open and willing to partnerships and corporate development, M&A activity if that comes along. It's a very attractive asset. It's got a long life, very high cash flow. Average annual revenues are just under $1 billion Canadian. Free cash flow of about $350 million a year. So really nice numbers on this asset and this project.
Right. Okay. So it's attractive in that sense, and I guess. And so in terms of the PNAV, do you think you're going to find it easy to raise the money if you wanted to? I appreciate you've got optionality and what you do and the timing on it, but one of the biggest destroyers of value for companies is raising the CapEx and getting this thing up into production. Have you guys got the stomach for that?
Yeah, we do. We put together a construction team to be able to do that. We're trading at right now about less than 0.1 times PNAV. Certainly with Lumina Group, they add a lot to our depth of bench strength. And, we're going to move forward on that basis. And if we see the opportunity to monetize the asset, then we'll monetize the asset.
Right. Okay. And it's just in terms of some of the other concerns that people have around mining, because it's kind of a bit risk-off environment still for juniors, even advanced development stories like yourself. Is the jurisdictional component in terms of the province, the kind of obviously they're getting behind this. Is that kind of fast-tracked this for you in any way? I mean, what are the other advantages other than them becoming a shareholder?
Well, we have regular meetings with senior people in the government who are responsible for not just this project, but also the metallurgical complex is located at a deep sea port facility on the east coast of Canada called Port Saguenay. The port is currently operating at 25% of wharf capacity utilization, so there's lots of room for this project at that location. And we have a long-term lease now on an industrial park that is adjacent to the wharf, which is the location of the construction of the metallurgical complex. Now, related to that, we have some, sub-infrastructure projects which are funded by the government, different governments, different levels of government in Quebec. So these related projects are extremely important to the development of the Saguenay region. Saguenay is a municipality of about 150,000 people. It's an industrialized area. Great place to be building this project. And the support of the governmental agencies, and the port itself is a Federal Canada public port, is extremely important to the development of this project.
Right. And are they kind of funding infrastructure builds specifically for you, or are you the beneficiary of the generic infrastructure build for mining in the province? I'm just trying to understand how tight that relationship is.
No, it's a great question. Yeah, it's a mix of both. So there's electrical, high intensity electrical lines that have to be brought in, and the extension of a gas head for natural gas, as well as a conveyor from the wharf. So there's different elements. There's a processed water pipeline as well. So all of those elements are being funded outside of strategic. So they're not on our balance sheet. And we have essentially over-the-fence user fee arrangements for each one of those utilities. But it's important to recognize, the seriousness of the project, that, we have these government agencies at all levels, federal, provincial, municipal, participating in these related infrastructure projects that are tied into the overall BlackRock project.
Right. And I just think that's important, and given the nature of what you're doing, the scale of of the ambition, and also the fact that we're talking about a 39-year mine life on one project. You got to have the infrastructure in place and the backing of local and federal government for that, I'm sure. But here's the kind of, I guess, the bit that people will be looking at you going, well, here's the difficult bit being, it's a 1.5 billion initial capital requirement. Right. So how much and what type of money are you getting from government, from the various agencies, and what type of money is Orion Mining talking about matching? Yeah.
So, well, first of all, I would say that you really can't do anything of this scale and nature in a place like the province of Quebec in Canada without the full backing of the First Nations. So the first thing is that we have a life of project impact benefit agreement in place with the Cree Nation government. And we have two different agreements, development agreements in place with three different bands of Innu Nation. as well as municipality cooperation agreements with all of the municipalities that touch the project. So all of those individual stakeholders are essentially leaning in to help with the sponsorship, financial sponsorship of the company in ways in terms of using relationships to get the financing done. So in terms of the financing that's coming from government just for the CapEx, we do have approximately 25% coming from government on top of an application into some of the federal funding as well. So there may be a way to top that up slightly. In discussions with our private equity groups like Orion, we think that them are basically matching the government's contributions would get us to roughly around 50% of our overall CapEx need. And so
is that debt?
In discussions.
Is that debt?
It would be debt and equity. It's a mix of debt and equity.
Okay, okay.
Yeah.
So some dilutory component.
So there's serious
in that.
equity sponsors.
Okay, I understand. But this is the problem. This is the quandary that you guys have to face. Getting the money is great. Getting it in as least dilutory way as possible is what your shareholders will be looking to you to do. So in terms of
for sure, how
much equity you expect to have to give away on raising 1.5 million? Can you give me sort of breakdown of what you think the debt equity ratio would be?
In simple terms, we're thinking about 50 to 60% debt and essentially the balance of equity, and that might take a couple of different forms, potentially some convertible, some common, and there might be a royalty piece as well. So that's what we're looking at today.
All at Pubco, or would you do some at asset level? What could it look like?
We're looking at both, but our sort of simple plan forward is at Pubco.
I guess you're going to go through the phases now, are you? In terms of you talk about over the next 9 to 12 months raising $750 million, so you can start construction in 2024, spring 2024. Again, how would that money kind of layer into your work program as you're imagining it now?
In terms of the cash spend waterfall, is that what you mean?
Yeah. So how much do you need to raise now? How much? Because look, 140 million market cap. You want a chance for this thing to breathe and the story to get out there, and drive that share price, drive that market cap, so it becomes cheaper money as you raise. Or do you go and raise it all now? So I'm just trying to understand the phasing of the money coming into the organization and the deployment.
Yeah, I think we'll have significant commitments for most of the funding by the end of this calendar year, and that's our plan, so that we can be comfortable to break ground in the spring of 2024. And that's also what our stakeholders, some of whom are big investors in the project, are looking for.
Right. So you're talking to institutional rather than retail or high net worth or family office and institutional money here predominantly. Is that right?
Yeah, that's correct. I would say that these are pretty big ticket items, and it's not typically something that we would do a smaller retail raise for. There probably likely could be a public equity piece to this as we continue through this year. But the discussions that we've had with the bankers and with project finance teams, for the 99% of that is institutional.
Absolutely. And so how are you imagining the liquidity gets driven? Because obviously a whole bunch of big companies sitting on stock.
Sure.
Doesn't do much to drive the share price. So again, what's that balance in terms of the register look like?
Yeah, well, I would say that, on the trading side, we've had, interest from retail, from high net worth, from family office. We'll continue to do that. So we raised $14 million at the end of March, in conjunction with this business combination transaction. So that was, essentially, 75% institutional and about 25%, 30% retail, high net worth. So we'll continue to do that. We'll continue to get the story out there. We'll work hard to explain to people what we're doing and why we're doing it and why this is going to be a great company.
Okay, and just tell me this in terms of those institutional conversations, but I guess more recently conversations with the government and various government bodies is in Canada we're seeing a huge support for all things green, net zero, and ESG. So you've got green steel, you got low carbon pig iron production, you've got vanadium batteries feeding into the kind of the energy storage narrative down the line, and obviously you've been very clear about First Nations support and therefore presumably accompanying ESG credentials. So is there any pressure on you to actually deliver on those things as the project develops and actually gets into production? Are there any kind of punitive measures in place for you if you don't do those things? Because a lot of people talk a good game. Once they got the money, they don't worry about it too much. So how do you manage all of that?
Yeah. So, well, first of all, from a environmental, green perspective, this project does check all the boxes. All of our, power is hydroelectric, so it's green, it's low cost. If you're going to build a project like this is the place to do it, and this is the time to do it. Canadian governments just came out with the critical minerals list. Vanadium and titanium feature prominently on the critical minerals list. We know that, vanadium usage in the steel industry is very helpful to reduce the amount of steel that goes into cars and, reduces weight, etc. And, for battery purposes, the vanadium flow batteries for grid are, really the future for wind, solar power balancing of the overall grid. So vanadium industry expects that vanadium consumption will double over the next 8 years or so. So, a lot of good things happening on the vanadium side, same on the titanium side. And then on the iron side, it's, massive changes in the steel and foundry industry. So Canadian government has funded the conversion of the remaining blast furnaces in Eastern Canada for the steel industry. So, essentially all of those plants are being converted by 2027 into electric furnaces. What that means on a, sort of per plant basis, the demand for metallic iron, because that's what you need for an electric furnace, not iron oxide, metallic iron, is going up significantly. So the pull on the scrap supply, and then all of the metallic iron products that go into the recipe to dilute out the contaminants and scrap. So those are essentially pig iron, nodular iron, DRI, and HBI. And the one that the industry likes best is a high purity pig iron because the iron yield on it is so good. So this is massively important to the reduction of CO2 emissions in North America. For every ton of steel that's produced, 2 tons of CO2 are produced. So the steel industry is a huge polluter. By converting to blast furnace, or from blast furnace to electric, will reduce CO2 emissions in the steel industry by 2/3 per furnace. Okay, so that is a huge win for governments that have made commitments to reduce greenhouse gas emissions to the rest of the world. And so Canada is taking, strong steps towards that. United States, the same. Europe, the same. So those markets, North American market, European market for high purity iron products is, extremely high. We have all the traders calling us wanting these products and they can't find them. So they're in short supply, and what we're going to build and produce is in very, very, very strong demand and helpful to the environment.
Right. Okay. So true green credentials, you would argue, and I guess by the people who've signed up, most likely that you are. Just very quickly, Finland, most of what are you doing with it? Are you going to flip that out, sell it, just park it up for now?
So Finland is a former producer. So Mustavaaren project it's a former vanadium iron producer. Used to produce about 10% of the world's vanadium. It's currently shut down. I think our focus is on the BlackRock Project in Quebec, with, the idea that we could eventually restart Mustavaaren and supply. It's a very similar grade and concentrate that we could supply into the met facility in Quebec. Alternatively, we've got the optionality to flip it out. So we'd like to see Finland stay in the strategic resource portfolio, but we're always open to opportunity.
Okay. So I just wanted to so for now, your flagship, your focus is in Quebec. That's where
Correct.
your money's going, and that's where your time and effort is being spent. Okay, just want to be clear with that. And with regards to just, if I may come back to the money thing, because that's what people are going to be looking for in terms of. I just want to leave this conversation really clear in my head. You've got, I think you said, was it 12 million in the bank now, or thereabouts?
Correct.
Yeah, having raised 14 million recently. How much of your time is going to be spent on? Because you've got the 43-101, you've got a team. You said who can build this thing, and you want to focus on obviously raising the capital. So, is your time? Have you done everything you need to do apart from raising the money? Because you're fully permitted, etc. I want to know where you're spending your efforts out here. Is it pounding the streets and you're trying to work out where the money's coming from?
It's a great question, Matt. I would say like most of our time is focused right now on the project financing. We have most of the detailed engineering done for the mine site and a good chunk of detailed engineering done for the metallurgical complex. So once we, sort of have good visibility on the remaining part of the capital, we'll spend, sort of 4 to 6 months completing the detailed engineering, and then we'll be ready to break ground.
Right. So the expectation is that there'll be no conditions precedent or nothing taxing, certainly not in terms of timing, timing permits or licenses. That's all kind of good. First Nations agreements in place. So there should be. Well, what do you think the obstacles could be for anyone looking in at these? These are large tickets you're asking people to write. So what would they be looking at?
Yeah, for sure. So, there's been CapEx inflation. So overall inflation, that has to be closely managed and monitored. So we just updated all of our numbers in the 43-101 that we just published.
Right.
Taking into account all that COVID inflation. Some things are coming down now, which is a positive. I think the depth and experience of the engineering team is critical, both for the design of the plan, all the pilot work that's been done that has been completed to prove out the metallurgy of the products, and then the construction team. So we're building in a very industrialized area that has a lot of experience in both mine building and met plants. So, we're comfortable with the group that we put together in terms of project management, et cetera. But I think those are the focus areas for investors.
Okay. And obviously commodity prices, right. Metal super cycle coming. We need all of the above. I'm very pro money, so I'm asking this in that context. Is obviously vanadium's had a sort of a bit of an erratic time since 2000. Well, for a long time, but 2016 onwards is a kind of strange looking chart. And given it's what is it, 25% of the value of the metal in the ground?
Yeah.
Is that right? Okay.
Correct. Yeah.
You must have an expectation of what's going to happen there, because obviously, I think you said in your presentation, it's, vanadium batteries are fairly nascent in terms of the technology there. The use in stainless steel continues to kind of, drive that market. How essential is the vanadium revenue to this? Can you just remind me of some of the numbers here? Can this stand up on its own 2 feet with just the iron component?
Yes. So that's kind of the way we look at it, Matt, is, basically the iron can pay for all the costs of the project, and it's very stable. It's, growing. And, a lot of industry experts see a lot more growth on that iron side. So that's core to the overall business plan. I guess the way we look at the vanadium piece is that you're right. It's very volatile. So, we've seen prices as low as, maybe $20 a kilo and maybe as high as like $125 a kilo over the period that you spoke of there. And that's kind of how we look at it, because in those peak pricing times, we're exposed to the pricing. That's the way our tolling and offtake agreements will work for the vanadium. And we want that exposure to the volatility because, when we get into high price vanadium territory, that's an opportunity to, essentially print a lot of money for the company, pay down debt. And we've seen other vanadium players do that in the past. But none of them have had the, 2/3 of revenue coming from the iron side. So very stable from the iron side, great opportunity on the vanadium side to be able to, have some really good quarters. And then really the titanium is just, cherry on top.
Right. Okay. And with regards to, obviously, we understand that the CapEx numbers. Actually, let's keep it real simple. So the payback is how quick?
So initial capital about 1.5 billion Canadian, and EBITDA just under 500 million a year. We're looking at after-tax cash flow of about 350 million a year. So, 4 years essentially on an after-tax cash flow basis. Project IRR is 18%.
Okay, which is solid.
NPV for the project is like about 2 billion.
Yeah. So it's solid, steady state. Call it 40 year life of mine. Okay, which is fine. And obviously, people may not have the benefit while listening to this or watching this of looking at the charts, but they should. In terms of it feels like a fairly steady state, certainly in terms of the free cash flow component. Is that the idea, or do you feel you need to kind of ramp things up in the earlier years to kind of help that kind of payback period? I mean, how are you approaching this? I guess a lot.
Well, we have lots of interesting additional phases to the project, which are expansion opportunities. So, we drilled off a second pit at the deposit, so we could increase the scale of the mining and the rate of mining. So that would be a simple growth opportunity. At the, within the tailings that we produce, we have a very nice ilmenite component. So that's additional titanium resource, which we could put in a grinding and flotation circuit to produce a separate ilmenite, which is a titanium feedstock concentrate. So, that's a very interesting expansion opportunity for going forward. On top of that, we're fully permitted for a ferrovanadium plant and an electrolyte plant at the port of Saguenay in Quebec. So we have not included that in this phase of scope for the project. So we could forward integrate to produce our own ferrovanadium at the port. And, then we've got Mustavarin, so the $2 billion NPV doesn't include Mustavarin. That's on top. That's a very interesting asset. And there's all kinds of optionality that's built into that. So, we have some really, I would say neat and interesting future phases to the overall project and for the company.
And would you argue that the build design is fairly simple? I get it big, but it's fairly simple. There's no sort of new technologies here. This is fairly standard stuff. It will take 4 years to build, and then maybe another year to ramp up. Is that the way you're looking at it?
The deposit, the deposit itself is a magnetite, so it's highly magnetic. So it's crush grind, magnetic separation. For the VTM concentrate, there's no flotation required. So it's trucked to a rail loading station and goes down the CN rail line to the port of Saguenay, where it's processed. And all of the processing metallurgically is very simple and straightforward. And these are old technologies. There's nothing new about it. I would say the configuration of what we're doing for VTM is somewhat unique in that we're doing it in a cleaner, greener way than anybody else in the industry. So, Tenova, which is our OEM on the furnace at at Saguenay has told us this will be the cleanest and greenest iron plant in the world.
Well, to that point, and when we've looked at other commodities who are feeding into the kind of the battery, the EV thematic, more conventional, the coppers and nickels and lithiums of the world, they're looking at premium pricing depending on the jurisdictions. Obviously, North American, everyone's got their own critical mineral list going at the moment, and there's some real drivers there for OEMs to demand the greenest possible commodities used within their product. For you guys, do you think in terms of pricing, there'll start to be a kind of bifurcation in the market in terms of clean versus some of the stuff we see coming out of Asia? Is that part of your thinking?
Yeah, it's not in our base business plan, so we've been very conservative with our pricing assumptions. But we do believe that there will be some bifurcation there. There's certainly a lot of discussion going on around that, and government policy is going to lean that way with, various carbon taxes being put in place at different borders, et cetera. So for sure, products down the road that are, greener and cleaner, and, those OEMs, the end buyers, the users of these products are looking at, their life cycle analysis to understand, what, they're buying and, how carbon intensive and how polluting are those products. So we do see that in the future. It's not exactly clear how it's all going to play out.
Yeah, it's interesting times. Certainly, governments and politicians taking great strides to get their green badges on. Well, look, I think it's a kind of first pass. Really interesting, Sean. The scale of the ambition is noted. I've been intrigued to sort of see how you get on with this. Bringing the equity component in and how you face that. And is there any with the conversations you're having with obviously Orion and Quebec was government? They are debt equity. You'll let us know what that mix is, I guess, when you've agreed that. At that point, you have those agreements in principle for what the amounts are and the cost of that money to you. Is that the time you kind of step forward and invite other, whether it be institutional money or potentially even industry money in, and what's the sort of timing of that?
So yeah, we're out there right now doing that, and we'd like to see everything put in place, Q3, Q4 this.
Which bit? Sorry, just in case I'm missing it, Sean, have you already got an agreement in principle about the cost of the money from Orion and the Quebec West government?
No, we're currently working on that piece, as well as, we're out there looking for the balance of the financing that is required. And we're currently doing meetings, and, we're in discussions with interested parties right now.
Okay. So, and it always comes back to money, sorry for me. When you mentioned convertibles, are you saying either of those two groups are looking at convertibles as part of this? Is that why it's debt equity? Is that what
there could be a convertible piece. It's not exactly clear yet. I think that'll get right. In the next month or two, we'll be able to clarify what the forward capital structure will be exactly. Based on the interest and based on
right. And do you need that?
I was going to say based on what the cost of debt is going to be. So, because I think that's really going to factor into the decisions there.
Right, because those the lead orders, and everything kind of spins off of that. And that's why I'm interested in sort of your options for mitigating the kind of dilutory component. Right now, I guess for you, given the bulk of it's institutional, they've got a much longer view of these things. It's less of a concern. And I guess with the convert component, it gives you and with the debt at some later point a chance to kind of refinance this thing out if the markets pick up as well. Right. I suspect. Great. Well, look, Sean, love the story. Thanks for making time to come and speak with us, and good luck in getting out there and sharing your story with everyone. Thank you.
Well, thank you, Matt. Appreciate it.